Hey everybody, welcome back to Accounting Time. We are all the way up to Chapter 7 in our Solid Footing book. And time flies when you're having fun, you know. And we've covered all kinds of foundational accounting topics. We've talked about the ledger accounts. We've talked about the journal and how to make a journal entry, post it over to the ledger accounts. We've even talked about how to take those entries in ledger accounts and turn them into financial statements like the balance sheet and the income statement. You've also hopefully had the opportunity to put all that stuff together, what we call the accounting cycle, and go through an entire month of accounting. Now we're at the point where we're ready to start making what we call adjusting entries. And we're going to learn all about adjusting entries in chapters 7 and 8 of Solid Footing. So we'll begin that journey right now in our video today by covering a topic that you probably know something a little bit about already, but we may need to tweak your knowledge a little bit. And that's depreciation. So we're going to jump right into it. Chapter 7 in Solid Footing. Here we go. We got a brand new company. You all can say goodbye to Gray Company. We'll have a new spreadsheet that we're working with in Solid Footing. It happens to be Lenny's Lawn Care, and we're dealing with a business starting in year 2. So all the setup activities, the purchasing of equipment, and funding the business and all that have already been done. We're beginning year 2 of accounting here for Lenny. And it's a little bit different than Gray Company in the sense that Lenny's is a pure service business. We're going out and we're mowing people's lawns for them. We're not selling any inventory. Because we don't have inventory, we don't have cost of goods sold. So it's going to be a little bit easier to record our sales transactions because we won't have that part of the entry, debit cost of goods sold, credit inventory. We just have the part that says debit cash or accounts receivable, credit revenue. All right? It's also, like Gray Company, organized as a corporation. So brand new company. Man, it's exciting stuff here. We're going to be doing Lenny's Lawn Care pretty much all the way through Solid Footing now. Chapters 7 through 10 to the end of the book are going to be Lenny's. So strap in and be ready to put your lawn mowing accountant hat on because that's what we're going to be dealing with. I got Lenny's chart of accounts up here, the general ledger I should say. And you can see there's a couple accounts on here that we haven't really done anything with yet. Don't know about. Like this one right here. I got unearned revenue. We'll talk about that in chapters 7 and 8. We've got a couple of new expense accounts over here. We've got a depreciation expense account. We got a supplies expense account. We'll talk about those. We have a couple new asset accounts. We got a supplies asset account. And we got accumulated depreciation over here. So all kinds of new accounts to talk about in chapter 7 and 8. So if you're kind of getting bored with the old accounts, hey, this is your chapter right here because you get to meet some new friends today. All right, so here are our goals in chapter 7 and 8. What we're trying to accomplish. We want to learn about these adjusting entries. Now, adjusting entries are always made at the end of the accounting period. So again, if you want to print off these notes, you can follow along with me. I'll put them up in Canvas for you. We make adjusting entries at the end of the accounting period. And the reason we're making these adjusting entries is to kind of clean up the accounting records a little bit. We want to bring the accounting records up to date and have them reflect things that have happened during the accounting period, but we haven't recorded yet. And a lot of these adjusting entries, pretty much all of them you'll find, don't really involve a transaction that has happened. It's not like, regularly where someone comes in and buys something and we record an entry, or we go out and buy something and record an entry. These are things that sometimes have to do with the passage of time. Not really a transaction that initiates it, but we're just looking at the records to clean things up to reflect things that have happened during the accounting period. Now, I know that kind of sounds confusing. We get into these entries and give you some examples. Hopefully, it'll make a little bit more sense. An adjusting entry always involves one balance sheet account and one income statement account. That's it. Usually one's to debit and one's to credit. One balance sheet, one income statement. And usually what we're doing is we're moving something from the balance sheet to the income statement or vice versa on an adjusting entry. So I'm going to say that time and time again as we're doing these examples. Adjusting entries. One balance sheet account, one income statement account. You'll get so Sick of hearing me say it. But you'll learn it. So it's all part of the method to the madness here. We'll also practice a whole lot. We're going to do the accounting for 3 entire accounting periods, January, February, and March. And we're going to journalize, we're going to post, we're going to balance, we're going to create those financial statements, and it's going to be a flurry of accounting activity in all of those months of examples that we do. So here we go. January, brand new company for us, year 2. And you can see we got some transactions going on here. We're going to pay for truck rental. We're going to buy some supplies. We're going to, property management company pays $22,500 cash on its account. So we're going to collect an account receivable. We're going to bill for work that we've done, set up an account receivable. And then we're going to pay our employees. That's stuff that we've already done. We've done those transactions quite a bit. So I'm going to pause the video right now and fill these in. If you want to pause yourself and try to fill these out, you can check them against what I have. Let's begin with that. Okay, so hopefully you've had an opportunity to go in and fill out the journal for the transactions that we had right here. You can check your work against mine. A couple of things I want to point out to you. On January the 3rd, it says we paid $925 cash for supplies. Now, we don't have inventory because we're not selling anything. Supplies is basically just things we use to operate the business. In this case, it could be oil filters, it could be shop rags, it could be whatever kind of supplies we need to kind of keep the lawn mowing business going. And it says we're totally using up all of those supplies in January. As such, the cost of the supplies should not be put in an asset account. An asset is something that we have and still have and can use in the future. If we used it up, well, we can't use it in the future. So you'll notice we have 2 supplies accounts. We have a supplies asset account. We have supplies expense. The asset account represents what we still have and can use. The expense account represents what we've used up in that period. So because we've used all that up in the period, it all goes to the expense account. None of it goes to the asset account. If we still had some left over, we'd make sure it was recorded in the asset account. The other entries, like we've already practiced before, the collecting of a receivable, the booking of a sale. As I mentioned before, we don't have cost of goods sold in inventory because we don't have inventory. We're selling a service here, service revenue. And then finally, we paid our employees. So all that stuff is review. If you want to take an opportunity to post your entries to your little ledger here, you're welcome to do that. As you can see, if we post everything over to the ledger, our general ledger looks like what you see right here. All those amounts are posted to the exact same spots that we wrote them out in the journal entry. We don't flip-flop, we don't switch them around. If we put a debit to truck rental expense, we put a debit to truck rental expense, okay? It doesn't get flip-flopped. I had some confusion on that on some of the other homework problems earlier on. People weren't sure how to get them from the entry to the ledger accounts. Yeah? You just copy them. It's as easy as that. So, a little bit of a review there. Now you need to put on your thinking cap because here we go with the new stuff. We have equipment in our business here. It was bought in year 1. Says January of the prior year, Lenny bought $48,000 worth of equipment. And we can see that in the ledger account. You can see it right there. $48,000 worth of equipment. Okay? It could be the lawnmowers, it could be the weed eaters, whatever you want to envision here. That's the equipment that we've bought. So Lenny's going to use that equipment for 4 entire years in the company or in the business. And we call that time period for that equipment the useful life. So go ahead and jot that down. That's an important concept here. How long do we plan to use an asset, whether it be equipment or a building or a vehicle or a factory machine, whatever the case might be? How long do we plan on using it? It's called useful life, okay? And that's an estimate. We don't know for sure, but we give it our best guess when we start using it, how long it's going to be able to be used for. Because Lenny is going to use that equipment over multiple accounting periods, 4 years worth of accounting periods, he has to spread out It's a big fancy accounting term there for you. Spread it out. He's got to spread out the cost over that time frame. Okay? $48,000. He's going to use that equipment 4 years. He's going to spread out that $48,000 over the 4 years that he uses that equipment. In accounting, we call that depreciation. Now, you've probably got some kind of mental connotation about that word. And maybe it came from like buying a car. You may have heard before that the second you buy a new car and you drive that new car off the lot, it depreciates in value 25 to 30%. That's not what we're talking about in accounting. We're not talking about something going down in value. We're not talking about wear and tear. All we're talking about in accounting, spreading out the cost. That's depreciating. We're taking the cost we paid, spreading it out over the periods we're going to use it. Okay? So that's one thing we kind of have to brainwash you on. Your previous idea about what depreciation is probably different than what it really is in accounting. So again, what it is, taking what we paid for an asset, spreading it out over all the accounting periods we plan on using it. What it's not measuring wear and tear. It's not measuring a decline in value. It's not an account we've set up to kind of create a sinking fund that we put money into to replace an asset down the road or anything like that. All we're doing, spreading out the cost of what we paid for an asset. Okay? That's depreciating. So, how do we depreciate? In Principles of Accounting, we learn one method for depreciating an asset, and it's called straight line. Now, there are about 4 or 5 different ways in reality that we can depreciate something, and we learn about those in second year accounting if you're an accounting major. But for now, we learn what's probably the easiest and most simple way to depreciate. And that's fine, because what I'm getting ready to show you is the way that most everyone depreciates stuff anyway. They don't do the hard methods. They like to do the easy ones. So this is kind of what happens in a lot of the cases when we're trying to depreciate an asset. When we do straight line, it spreads out the cost evenly over every accounting period that we use the asset. Okay? So we got a name. Now we just need to figure out how to do it. Here's our calculation. What we paid minus something called salvage value. What do we think we can get out of it when we're done with it? We're going to get some money out of it. We can sell it off maybe when we're done with it. What's it worth when we're done with it? That equals the amount we need to depreciate. We divide that by how many years we're going to use it, and that gives us our depreciation expense for that accounting period. So just to give you an example, we know that Lenny paid $48,000 for that mowing equipment. He's going to use it until the wheels fall off. No value in that equipment whatsoever when he's done with it. And that's pretty typical. So the amount we have to depreciate on that mowing equipment, $48,000. We divide that $48,000 by the life of 4 years. 48,000 divided by 4 gives me $12,000 a year. All right? Simple as that. Now, if I were going to do it monthly, I wanted to make my entry every month at the end of the month, which is what we're going to do, well, I just divide that by 12, right? 12 months in a year. Right, take that annual amount, divide it by 12. We get $1,000 a month. So that's my magic number. Every month at the end of the month, I'm going to make an adjusting entry to book $1,000 of depreciation on that equipment. So that's the background. Here's how it works from a journal entry and accounting standpoint. We have the expense account. And again, just like all the other expense accounts we've learned about, we're going to be making a debit to that to record our monthly depreciation. All right? That reflects the amount of depreciation we have in the current period that just happened in the period we're in. The offset, the credit side of that, is something called accumulated depreciation. It sounds exactly like what it is. It's accumulated. It's all of it added together. It holds up all the depreciation we've recorded over the life of the asset. Now, here's the wonky thing about it, though. It lives on that asset side of the accounting equation. All right? And you all are good accounting students. You know, you've been taught on the asset side, it's on the left-hand side. So it goes up on the debit, goes down on the credit, and you've learned that. Well, this one works a little bit backwards. It's what we call a contra asset account. And I'm not talking about like the old Nintendo game Contra with the cheat code up, down, left, right, B, A, start, and you can get 30 men or whatever. I'm talking about contra, meaning opposite or backwards. You can see it works the other direction. It goes up on the credit and down on the debit, and there's a reason for that. I like to say that contra accounts are the ex-wife or the ex-husband or the ex-boyfriend or ex-girlfriend in the accounting world. And what I mean by that, their only purpose in life is to bring something else down. And maybe you have an ex in your life that's like that. It seemed like the only function they have looking back was to bring you down. That's what a contra account is. Its only function is to bring down another account. In this case, it functions to bring down the equipment account when you net the two together. All right? I have $48,000 in my equipment account. That's what I paid. I leave that in there until I get rid of that equipment. Okay? It stays there, $48,000. The accumulated depreciation is measuring what I've depreciated and kind of nets against equipment. So the book value of that equipment, $48,000 minus $12,000, $36,000. It nets, it brings it down. Okay? Kind of makes sense? Contra asset. It's on the asset side, works backwards from all the other ones. So here's the entry. End of the month, we get the end of January. We're always making adjusting entries at the EOM, end of the month. Boom, we hit that expense account. For how much? Yeah, $1,000. Remember, we're doing monthly, not annual. And then I can't fit it all on here. I'm going to have to abbreviate. Accumulated depreciation. Boom. $1,000 right there for that credit. And you can see when we post it, the wavy arrow there, it's going to add to on the credit side. It's a contra asset. It goes up on the opposite or contra side. So that's our entry. Memorize that, because every single time you make an entry for depreciating, it's at debit and it's at credit. All right? If we don't make that entry, let's say that you're like, I don't believe in depreciating. It's just not part of my accounting belief set. If you don't make that entry, well, your assets are overstated, because look, you're not offsetting that $48,000 with the accumulated depreciation. Your expenses would be understated because you didn't record that expense of using or spreading out the equipment cost. Because your expenses are understated, your net income is overstated. You're reporting more profit than you really earned in that period. So it's a pretty big deal. In auditing class, we'll talk about frauds, accounting frauds that happened because people were playing around with their depreciation entries, not making them correctly. You put all that together, here's what we got. We got our ledger accounts right there. We just booked a debit to the expense account, offsetting credit to accumulated, just like that. All right. And make our financial statements. I'm going to pause right here and let you all fill these out. You can kind of pause yourself and fill these out. We're just going to use our ledger accounts here. Remember, we're always using the ledger balances, the ending amounts, and using the correct side that they're on to fill out our statements. We're going to fill out an income statement. We're going to fill out a balance sheet. So take those ending amounts, And let's go ahead and fill out your financial statements. And I'll pause and you can do the same. I'm going to take and do the income statement to begin with. All right, so we got our income statement. Now I pulled my numbers off of the ledger accounts. I got revenue of 26 grand. I've got my expenses on there, totaled up. Revenue minus my expenses equals net income. You'll notice, again, no cost of goods sold, no gross profit because we're not selling inventory. So I've got all that info in there, and now I'm ready to do the balance sheet. The reason I wanted to do the income statement to start off with, if you remember back to our chapter on closing entries, is we need that net income amount to be added to our retained earnings balance. All right, so we have to do that income statement first, and then we can do the balance sheet after we've calculated net income, because net income is going to add to our previous or prior retained earnings balance. So here we go. I'm going to pause. You can fill in your balance sheet while we're paused. I'll fill it out, and then we'll come back and check and compare. Alrighty, hopefully the accounting gods were looking down favorably upon you, and you were able to get that in and able to get that balanced out. If you didn't, I'm guessing the reason might be right here, that accumulated depreciation that we had in that ledger account. We need to put that in as a negative. Remember, it's on that credit side. It's contra, it's subtract. So make sure that you put accumulated depreciation in on the balance sheet. It's always going to be a subtraction, a negative. I got all the other ledger account balances in there, the ending balances. $74,075 is my total on the asset side of the balance sheet. No liabilities. Common stock, $50,000. My retained earnings, had to do a little bit of math right there. I took my beginning retained earnings, $17,000. I added in the net income, and I got $24,075, which is giving me $74,075 on the liabilities and equity side. Remember your balance sheet, the whole idea, assets equal liabilities and equity. One other comment about that balance sheet. I noticed in our homework, make sure you label everything. I had some people that would leave out the total labels on total liabilities, assets, total equity. Make sure you label all your lines there. At the top, we put the name of the company, we put the title of the report, and then we put the date. They don't have a date under here for some reason. We'll put it in their form. January 31, 20XX. I don't know what year we're talking about here. So there we go. A perfectly formatted and correct, most importantly, correct balance sheet. Your homework for that part, 7.1 and 7.2 in solid footing. We'll do a couple more problems out of chapter 7, but I want to stop the video right here so we don't have a video that ends up being like an hour long, and try to keep them in little chunks for you. That way it's easier to go back and refer to it. 7.1 and 7.2. If you have any questions on those, let me know. We'll be back here in a few minutes with another video covering the second part of chapter 7. We'll see you then.